Hi there, welcome to Kneppyinvests. It's been about 1 year since I did a video on Zip, which was my last video on a buy now, pay later company. And really the froth out of this sector has really deflated in that time period. We've seen share prices of these buy now, pay later companies come under attack. Significant drops in the last year, particularly from August of last year. So those companies include Zip, Sezzle, Splitit, even Humm, a firm in the United States, and even Afterpay before they were bought out by Block. Block now is listed on the ASX as well as the NASDAQ. And we've even seen the share price of Block drop a fair bit, although it has rebounded the last few days. Now, one of the things I was looking at with intrigue when I researched these companies was bad debts. These are the debts that consumers of these products will use and then decide not to pay back those products they bought using buy now, pay later. And I always thought there was that risk that bad debts would be a problem for these companies down the line in the future. So I will be discussing bad debts in this video today. The main motivation for me doing this video today was just an acquisition of Sezzle by Zip. This has been in the pipelines for a while, and we are starting to see consolidation in this space. So Zip is buying Sezzle. We saw Latitude buy Humm, not the whole Humm, just their consumer finance section. We've also seen Afterpay being taken over by Block, and I think there is potential this is going to continue in the future. So consolidation can be good news, but usually when the consolidation period finishes, you will start to see growth slow down or potentially slow down. Now, this was the motivation behind me doing this video, but the really good feature about the timing of this acquisition by Zip of Sezzle, what is also coincided with the release of their half-year results. And I decided when I saw this acquisition, I thought I'd just look at the half-year results for Zip and Sezzle. And I did find a few disturbing things in the half-year results. Now, before we have a look at the half-year results, and the thing that really disturbed me about not only Zip but also Sezzle, just let's have a look at the lack of positive sentiment when it comes to these companies. So negative sentiment, lots of negative sentiment, well-defined downtrend in these companies' share price. In fact, Zip and Sezzle share chart looks fairly similar, particularly over the past 4 to 5 months. And this particular chart, the daily chart for Zip, goes back to June of 2020. And I just wanted to include the peak in the share price, which was reached in February of last year. This was peak hype time, not only Zip, but a lot of other buy now, pay later companies, but also a lot of those unprofitable tech companies in the United States. February was that peak. And ever since February of last year, the share prices of all these unprofitable companies have been dropping. If you don't believe me, just go have a look at ARK Innovation Fund, ARKK. That is Kathy Ward's, one of her most famous funds, and that has been dropping since February last year. And she typically invests in unprofitable tech companies. And the share price has fallen from $14.50 at the peak to a current share price of about $2.21. I am recording this video before trading has begun on the 1st of March. There is a possibility that we will see the share price drop another 10% when trading begins. So it wouldn't surprise me to see a trading of Zip around about $2 during the 1st of March. But the downtrend has really accelerated from October or middle of October last year, when the share price was $7. So share price has fallen from $7 to $2.21 in the past 4 months. So a lot of negative sentiment right now in Zip and also in Sezzle. And just to prove that, let's have a look at the Sezzle chart right now. Fairly similar chart, just like Zip, particularly from February. And that was, again, the peak in Sezzle's share price, which reached $12 towards the end of that month. And we did see that acceleration in the downtrend around August or September this year. At that point in time, Sezzle's share price was around $7.50 to $8.50. And right now, at the end of closing on trading February the 28th, the share price is around $1.78. So lots of negative sentiment in this space right now. Seems like Afterpay picked the perfect time to get out and be taken over, because that was right at the beginning of this particular downtrend. Now let's get on to looking at the financial statements for Zip, paying particular attention to the statement of cash flows and also to the P&L statement. Now, when I look at financial statements, I tend to start with the cash flow statement, and what I'm looking for here is any signs or anything that really stands out as being possibly negative or positive. So I'm looking at growth in operating income or cash receipts, and also growth in costs. I don't want to see costs growing at a quicker rate than cash receipts or income, but that's exactly what's happening with Zip. If we take a look at operating income from customers, that grew from 160 million to 302 million, so an increase of 140 million. But payments to suppliers and employees grew from 114 to 290 million, a significantly higher increase in payments to suppliers and employees. And I want to know why. Why did Zip see a significant increase in their payments to suppliers and employees? And that did have an effect on their operating cash flow. Last year, they were actually operating cash flow positive by 13.9 million. Now they're operating cash flow negative by 25.3 million. And it's all because of that significant growth in payments to suppliers and employees. The only thing to take into account for Zip and a lot of these other buy now, pay later is interest paid. That did increase from 25 million to 35 million. And that is something you have to take into account over the next few years, particularly if interest rates start to rise quite significantly. Usually when I finish with the cash flow statement, I go to the balance sheet, and there was nothing really in the balance sheet that gave me any clarity about why those costs did increase quite significantly in the past year. But if we go to the profit and loss statement, we do have a clue here. So operating income very close to the operating income we saw in, or the cash receipts we saw in the cash flow statement, almost identical. So operating income here, or revenue would say, or call it, increased from 160 million to 301 million. We saw interest expense increase just like we saw in the cash flow statement. Bank fees and data costs more than doubled from 25.8 to 56.6 million. But bad debts and expected credit losses increased fivefold from 29.5 million to 148.3 million. And that was the reason why we saw a significant increase in the cost of this business. It was just an explosion in bad debts and expected credit losses. And that is a concerning thing. If we look a bit further up in the financial statement, well, not financial statement, but the half-yearly report for Zip, there is a director report section. And in the director report section, they have a cost of sales part. And if you looked at cost of sales, they just mentioned here that bad debts and expected credit losses is now 3.3% of underlying volume compared to 1.3% last year. In fact, it increased by 403% from last year. Their expectations is that percentage of underlying volumes or bad debts of underlying volumes is or should be around 2%. So it's significantly above the 2% threshold for this company. And some of the things they mentioned about why they did see a significant increase in bad debts and why the percentage of bad debts to underlying volumes is well above 2% was for various reasons, including their risk settings. So they wanted significant growth, and to get that significant growth, they had to increase their risk, the economic environment, launching into new, less mature markets is something else they mentioned. So when you are launching or acquiring companies that are in those less mature markets, you are increasing the risk of people who will use your services and they're not paid back the things they have bought using buy now, pay later. They also mentioned here in the early stages of operations in these new markets, the credit decisioning model is being developed and revised as the new business learns how the customer portfolio performs in various scenarios. As such, the level of losses occurred is higher than would be expected in more mature markets. So it seems like to get these more significant growth in the business, they have become more risk-taking. So they're more willing, or have been more willing, to risk customers not paying them back when they've used the services. And as they've ventured out into new markets, those new markets have higher risk attached to them compared to Australian. And that is why bad debts have significantly increased over the past year. Seeing the growth in bad debts for Zip did ring some alarm bells for me, but the next question I had, was this a solely Zip problem or other companies in the buy now, pay later space experiencing the same sort of thing? So I went to Sezzle's financial report, and this is their profit and loss statement, starting with the income. Income more than doubled from 58.8 million to 114.8 million. Unfortunately, their operating expenses more than doubled as well, increasing from 86.7 to 183.5, which means their operating loss more than doubled as well, from 27.9 million to 68.7 million. If we delve a little bit deeper into the operating expenses, we saw significant increases in most expenses. Personnel 30 to 56 million. Transaction expenses almost more than doubled, from 22.5 million to 43.4 million. But provision for uncollectible accounts increased from 19.6 million to 52.6 million. So there was an increase in their bad debts or their uncollectible accounts or their provision for the possibility of uncollectible accounts, but not quite at the same rate we saw with Zip. They also mentioned the increase in provision for uncollectible accounts, and they are trying to rectify that. So they mentioned in their commentary, we began requiring a debit or credit card on file to make the initial installment payment when selecting to pay via ACH, which substantially reduced our first payment loss rates. Finally, we are continuing to work with enterprise merchants to integrate our product which will further reduce our loss rate. So it seems like not only does Zip recognize there is a problem, Sezzle is recognizing a problem as well, and they're both trying to fix it. The question is, are we seeing the same sort of thing with Affirm? Other buy now, pay later is in another country, and yes, even Affirm is seeing this significant increase in bad debts. This is looking at the most recent quarter, so 3 months to the end of December 31st, but I'm going to focus on the 6 months ended 31st of December. And if we go through the revenue, so they start with revenue, total revenue, and then they've got the operating expenses. So just like those other buy now, pay laters, we have seen significant increases in revenue. But the thing I want to pay attention to here is provision for credit losses, and it's grown in the last 6 months of last year from 41.4 million to 116.3 million, and in the 3 months ended 31st of December, it grew from 12.5 million to 52.6 million. A fairly similar problem than what we're seeing with Zip and Sezzle. And they didn't really mention this in commentary from what I saw, but I did see a lot of commentary elsewhere. And this is from investorplace.com. This is just a little snippet from an article there. On June 30th, 2021, Affirm had 2 billion in loans. Now they have 2.4 billion in loans. So this is 6 months later. This is a gain of $403 million of loans in 6 months. But its provisions for loan losses accounted for 116.3 million of this increase, or 29% of the total. In other words, almost 30% of its loans will turn sour. So this is a problem for not only Affirm, but also Sezzle and Zip. It's a lot of these customers who are using buy now, pay later are not paying back. That's all I have on this video on Zip's, Sezzle's, and Affirm's bad debts. A few years ago, I was thinking this could be a problem down the line for these companies, but over the last few years, it seems like they've kept a lid on this problem to a sufficient extent. But I think this need for growth has pushed these companies into higher risk markets, hence the rise in bad debts. They do know the problem, and they're trying to fix the problem right now, particularly Zip and Sezzle. I didn't see any commentary in regards to Affirms and how they might fix the problem. But bad debts is not the only problem these companies have to face in the next few years. Rising competition, I think that will be a significant threat to these companies. Also, increasing price of credit or cost of credit, that could be another issue these companies will have to face in the future. And that's one of the reasons why Klarna has gone into banking, to lower their cost of credit. If you have any questions about any of these things I've mentioned in this video, any of these companies I've mentioned in the video as well, just leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.